Hello, everybody, and welcome to the Like a Tortoise channel. Happy Tuesday. Today, I want to address one of your comments. First of all, if you are new to the channel, welcome. I do hope you make the most of it. And if you are not new, then, thank you so much for all the ongoing contribution, guys. And some of you have been leaving many comments, and I always read all the comments, just so you know. And in fact, it's exactly because I read all of the comments that I'm creating this video for you. And today I will be delving deeper into a company called Copart, which this is the first time actually that I'm analyzing the business, its financials. I know what they do, and it's in fact this is part of the reason why I decided never to invest in the company or even add it to my watch list, because I'm not really very interested in the industry. But you know, it's funny because this company has been on many quality investors radars for many months for sure, and perhaps even years. And they were buying this thing at when it was trading at about $60 per share, and believing they were paying a reasonable price. Whether or not this is true, I mean, remains to be seen. In my opinion, look, you know that I like to buy quality companies when they are trading at a big discount to their real value. And what I keep pounding on the table is this is eToro. You know, I always use eToro for educational purposes, and I use interactive brokers to execute all of my transactions. But when I'm with clients, I prefer to use I prefer to use eToro because it's more user friendly. And so what happens, guys, is that no matter how great the company is, I keep saying this, no matter how great the company is, there will be periods when they will face a temporary setbacks. Whether or not they will just be temporary setbacks and not structural impairments remains to be seen, right? Because we don't know. And that's why it's important to study the business before committing any of your real capital. But this company is now down about 40% from its highs. And this is probably one of the largest drawdowns. I can see one right here. This was actually more pronounced, about 50% decline. And then look, they managed to recover. But the point that I'm trying to make is wait. Follow the like a tortoise approach to investing. No matter how great the company is, never say, oh, look, it's such a high quality, it will trade at a premium forever. No, it won't. Even those companies go through these periods of uncertainty, whether it's a company specific event or a macro event that will cause the stock to come back down to your margin of safety level. And that's when you should attack. And Copart is no exception. So, what the heck is happening with this company recently? One of you mentioned in the comments that you wanted me to analyze the business. That's what I'm doing now. Look, I will is mostly delve deeper into the financials, and just to try to understand what the numbers are telling me and whether or not we have a competitive advantage, and whether or not the company may be trading at at a significant discount to its real value. Okay, I don't know the business. I would have to study its competition, and try to understand what their moat is. Okay, that's very important. Okay, so let's start by going to their financials and see what we can understand, and try to understand why the company has been facing selling pressure. Okay, so first things first, let's have a look at the industry. So Copart provides online auctions and vehicle remarketing services in the United States, the United Kingdom, Germany, Brazil, Canada, the United Arab Emirates, Spain, and so on and forth. It offers a range of services to process and sell vehicles over the internet through its virtual bidding, third generation internet auction style sales technology. Okay, so I have zero edge here. I just don't understand this industry, and so that's obviously a clear pass. Number one, I don't understand the industry, and number two, I'm not interested in understanding the industry. Okay, so if you don't understand it, that's a quick pass. Because what happens is you're going to have to read financial statements, you're going to have to read the company's quarterly and annual reports, And look, I mean, if this thing doesn't interest you, then you would have a very hard time doing that. And I love investing, and so there's no point for me in being in that position. I just stay within my circle of competence. So this one would be a clear pass. Maybe things will change in the future, but certainly not now. Let's have a look at total revenues, starting with the income statement. So I can see that revenues have been going up very nicely. Look at that. Since 2013, they have been compounding at about 13% per year. So solid growth, double-digit growth. I like to see that. Okay. Let's have a look at their operating expenses. They have also been going up at about 9.45% over the same time frame. So that's okay. Let's have a look at their net income and earnings. Look at that, very nice. So we have net income growing at a much faster rate than revenue. I like to see that. Okay, it means that the company has, in all likelihood, what we call right that operating leverage. So I do like to see that earnings are growing faster than revenues. This is always very positive, and the gap is actually pretty considerable. And another thing that I want to check is diluted earnings per share. Here we go. They have been going at 20.46%. Notice the difference. It's just a 1% difference. So what this tells me is that the company hasn't been buying back a lot of shares. Otherwise, this number would be higher. Okay, so we have to understand why that is. All right. And touching upon that, let's check what diluted shares outstanding have done. All right, and here we can see that since 2013, I can see that diluted shares have declined by less than 1%. So this company is not doing a lot of buybacks. There are many reasons why this might be the case. One of them, for example, is that the stock has always traded at a high valuation multiple. And so the company has decided not to use cash towards buybacks, right? And if that is the case, it may be sound. I don't know the valuations. We will look at it later, but that might be a reason. What I don't like, guys, is I don't like to see dilution. And what I can see right here, you can see very clearly that since 2020, there has been some dilution. Look at that. Shares have been growing by 0.5%. So I don't know why this is, but I don't like what this means is that they are diluting existing shareholders, and we have to understand why that's happening. Is this because of an acquisition? So we have to understand exactly what happened. Okay, and let's have a look. So the income statement looks pretty sound. I just don't like to see the diluted shares outstanding going up as of recently, but there may be a plausible explanation for that. Assets. Sounds, look at that, 24%. I like that. So they have total cash about almost 5 billion. Very good. And then non-current assets, liabilities. Oh, wow. Look at this. So they look at book value. So total assets minus total liabilities has been going up by about 30%. Very healthy. What's even more interesting is that I believe, they have a net cash position. In other words, Copart could, if they wanted to, they could pay all their liabilities using just cash and cash equivalents. So if I go here, I can see that they have net cash position. Look at that, net cash about 5 billion. They have about 4.8 billion in cash and cash equivalents, and then total debt is about 103 million. So they effectively have a net cash position, which is very, very good. So this company is not at risk of at going bankrupt, nor anything of that kind. So this is a big thing that I love to see in companies. If I go and so book value is positive, so nothing else. Balance sheet looks pristine to me. Cash from operating activities has been going up nicely as well, so I like to see that. Let's go straight into free cash flow, and you can see that free cash flow has been compounding at 30.42%, which is very healthy. Very, very healthy. So what this means is that this is a very profitable company. And my assumption here, based on what I'm looking at, is that they convert the majority of the earnings into free cash flow, which is exactly what you want to see. So this means quality earnings, right? So they probably operate in a low, they have a capital light business model. And in fact, if I go here, let's have a look at the capex. Now that I'm here, let's see. Let's go to financials. Let's go here to cash flows, trailing 12 months, and let's look at capex. Okay, so capex has been increasing, and this makes sense because the company may be investing into growth. Okay, so something that is good too, because the goal is to reinvest a lot into growth, so the business, so that reinvestment can turn into profit later on. So if that is the case, that's great, because that would be growth capex. What I don't like to see is a lot of maintenance capex, which is another portion of capex. And maintenance is how much cash the business needs to use just to maintain current operations. And what we can use as a proxy for that is the depreciation and amortization, and you can see that it's about 202 million. So I mean, this company is quite, yeah, exactly. So it's very, very low capital. So it's a very capital light business model that doesn't need to invest a lot just to maintain its current operations. And this is something that I really like to see as well. All right. Now, another thing that I want to check, look at free cash flow. We already discussed that, just going through the roof. So very profitable. Balance sheet looks pristine. And another thing that I can already see is that they don't have a lot. They don't do a lot of share-based compensation, which is something that I really like, because when you are doing your valuation, remember that share-based compensation so is should be treated as an expense, in my opinion. And so what I like to do is I strip out share-based compensation from the free cash flow if the number is quite high. Okay, and so take that into account. But in this case, look, share-based compensation as a percentage of revenue is less than 1%. As a percentage of free cash flow is less than 4%, very low level. So I love seeing that. Okay, all looking great, guys. And what else do I want to check now? Okay, so what we can do right now, we already discussed some of the most important ratios here. And look at that. So the free cash flow yield is about 3%. The earnings yield is about 3.88%. And what this tells me here is that the business is not as cheap as you may think it is. Okay, and if you look at the free cash flow, for example, if you look at the price to free cash flow, and we can definitely do that in the case of Copart, we will be analyzing price to earnings and price to free cash flow. Look how steady net income has been growing. Where is it? Net income. Look at that, beautiful. Okay, and the same goes for free cash flow, growing very steadily. And so we can certainly use these metrics at the time of running a valuation on the company. And let's do that right now. It's right here, Copart price to earnings, price to free cash flow, as you can see. And if I go back to 2015, I can see that the average price to earnings is about 30, and the average price to free cash flow is about 48. Right now, we are at 25 on price to earnings and 32 on price to free cash flow. That's not really cheap. Okay, you can make the case that the company is cheap relative to its historical averages. However, it's not cheap. All right, and you can see, for example, that they reached a low price to earnings in 2016. That was the cheapest they've ever traded at, when the PE was about 15 and the price to free cash flow was about 21. This, yes, is already cheap by my standards, but I don't think this is cheap. Now, granted, it's a premium company, You may argue that it deserves to be trading at the premium, but as you probably know me already, if you know me already, you know that I want to be more patient, and if this thing continues to sell off, then you guys could consider buying it, but certainly not. So I personally wouldn't be buying it. If I like the company, if I understood, if it checked all the boxes, I still wouldn't be buying it on a valuation standpoint, based on the price to earnings and price to free cash flow. And sure enough, look at this. If you look at the price to if you look at the forward PE, that's about 24 times 24 times. Certainly not cheap. Okay, and but now what I want to do as well is I want. Oh, and by the way, so look at the earnings yield is about 3.88%. But if you know, you can get about 4%, even a bit higher than 4% with bonds. Okay, and bonds, as you probably know, are less riskier than stocks. And so I like to see a higher earnings yield to account for all the risk that I'm taking when buying a company. Now, this is only based on current earnings, and it's true that Copart is still expected to grow in the future. However, my margin of safety again is not as attractive. And look at what analysts are projecting for growth over the next 5 years. They are projecting EPS to grow at 7.81%. So call it 8%. 8% growth, and you still have a forward PE of 24. That's not cheap in my opinion. Okay, so this thing would have to come down more significantly for me to be at least interested in the company. All right. Okay, let's discuss now the intrinsic value of the company. So, look, from a financial standpoint, I really like what I see. I mean, this is definitely another thing that I wanted to show you guys. Let me go back here. I can almost guarantee that there is stability in the margins. Remember that stability, so when you see margins consistency, this is one of the first things that you should be looking at when determining the competitive advantage of a company. And sure enough, if we look at their financials here, and if you look at their metrics, let's have a look at the gross margin right here. Exactly what I thought. So look at that. Look at this steadiness. Okay, since 2014, the average is 44, and right now we are at 45. I love seeing that consistency. Okay, this is a sign of a moat. Now let's have a look at the operating margin. Look at this consistency as well. The average is about 35. Right now we are at about 36. You can make the case that this thing has been declining since 2021, which is true, but maybe some normalization post-COVID. You have to understand why this is happening. Why is operating margin declining? Yeah, this is something that can be tied into the stock market underperformance as of lately. Okay, so you have to understand the business and please understand why these margins are being under pressure here. And now let's have a look at net margin, which I assume is okay. So look at this, very nice. The net margin has been going up since 2022, and right now it's at the highest level since 2021. Very, very good. The average is 27, and right now we are at 33. I like seeing that. Okay, so look, this is a very good company. In fact, even stock and lock rates it 4.23 out of 5, which definitely means that the company is very sound. If I go here to insights, you can see that profitability, they have a 4.6 profitability score. Management also has a high score, very good. Okay, share-based compensation is low. Let's have a look at now that we are into management, let's have a look at their return on invested capital. In other words, this is the most important metric, guys, and I want to see how well management is doing at deploying shareholders at investing capital. Sorry, how well management is doing right, at deploying shareholders' money. And so for that, we need to check the return on equity. And then I want to see the return on invested capital. How quickly, how effectively the company is turning profits from invested capital. And so these two are important. Typically, I like to see metrics above 15%. Return on equity has been going down sharply. Look at this. In 2014, it was about 33, and now we are at 16.90%. We have to understand why this is happening. I don't like seeing that. I'm more of a turnaround guy. All right. So typically, when I invest in companies, these metrics are improving, not decreasing. Okay. So again, understand why the return on equity has been going down. It's very important. We are trading well below average here. And another thing is return on invested capital. Phew, look at that. It took a significant hit as well since 2022 when it was at 34 and now we are at 21. Okay? So not ideal. And we have to understand why this is happening. Look at the average 25, now we are at 21. Still, I mean, it's been a sharp decline since here. So what's happening? Is the company, because remember that capex has been increasing, and what happens is if the company is investing a lot into growth, it may take a while for those investments to turn into profits, and that will hurt return on invested capital in the meantime. So if that is the case, then this may be warranted. But again, you have to understand that. And now what I want to see is value from a valuation standpoint. We discussed the PEs in these multiples, but let's have a look at price. Let's have a look at the intrinsic value of the company. And for that, I'm gonna. This is a company that has been growing a lot. Let's just use the DCF model, okay? And let me open my Excel right here. I didn't do that for Copart, but I will just replace the numbers here. Let's use 2024 metrics. Forget about. Let's just use this, okay? This is 2025. So what is we can use free cash flow because it's been consistent. If we use free cash flow, the latest free cash flow for the company is what? About 1231. Let's use that. 1231. Okay. Now analysts are expecting growth of around about, let's call it 8% over the next 5 years. The company has grown more attractively in the past. I can use a higher multiple, but let's use 9%. Okay. And what happens here is I always want a discount rate. I use 15%, guys, because I want to double my money every 4 to 5 years. And for that to happen, you need to compound money at 15% per year. So 15% is always the discount rate that we use at Like a Tortoise. And I'm assuming a 2.5% perpetual growth rate. Let's have a look at the cash and cash equivalents. And we can see that if I go here to financials, cash and equivalents, trailing, cash and short-term investments, 4789. What's the total debt of this business? Total debt 104. Shares outstanding. How many shares outstanding do we have? Right here, 978. And if you do that, what happens is the DCF price that you should pay is about 20. And right now, this thing is still at 40. So it would have to come back down a lot more for me to remain interested in the company. Yeah. And the reason for that is exactly because I'm using, look, they so the stock analysis analysts are projecting earnings growth of about 8% over the next 5 years. Let's see what FinChat analysts are expecting and see if they expect just about the same thing. Copart. I like to look at different stock analysis platforms because they give me different insights and the analysts price the stock achieve. You see, look at this. So these analysts here are projecting long-term EPS growth of around 12.3%. All right. And so let's use that. Let's use 12%. If free cash flows are going to grow at 12% over the next 10 years, then the price you should pay shouldn't be this should be about 21% if you wanted to double your money every 4 to 5 years. Okay, but most people will use a discount rate of about 10%, which of course will inflate the DCF price per share. In this case, the price you should pay is about 35, which is not that far away from where we are trading right now at about 41. But I'm not like most people. I'm more of a turnaround guy, and I like to have a margin, a higher margin of a bigger margin of safety baked into my assumptions, and so this is the price that I wanted to pay. Now, if you want to ask yourself, let's reverse this. Let's ask what is the market. What's the current growth currently implied in the current stock price? And for that, we have to up the growth rate in order to up the DCF price per share. And so if I use, say, 15% growth, oh, sorry, uh, what's happening here? Growth rate is, yeah, exactly. So not even, let's use 25. Exactly. That's about where the price, that's about, so right now, the market is pricing this company as though its free cash flows were going to grow at about 25% per year over the next 10 years. And you, as an investor, should ask yourself, is this plausible? Do I think the company can achieve that? And if not, then there might be other better investment opportunities in the market. So for me, this is definitely a pass. I'm picky, and I want to have a much bigger margin of safety. In other words, in all likelihood, I wouldn't be interested in the company until this thing were to about 35, 34, anything between 35 or 30, as to be fair. This is what would probably get me excited. I wouldn't be because I'm not interested in the company, but if it remember, I'm just saying it if it checked all the boxes, if it checked all the other boxes, and what the reason that that kept me still a bit that kept me reluctant was the fact that the valuation of the business, then I would definitely be interested at about 30. Okay, and before that, absolutely not. Anything beyond that is just I think you are just overpaying. Okay, so look, that's my thesis, and I hope that you guys managed to understand a bit more about my investment process. I just try to be as clear as I can, and I use different valuation metrics when it comes to assessing the margin of the intrinsic value and the margin of safety of a business. For this particular company, I use the reverse DCF and the DCF model, and yeah. So I hope it's been helpful, and if it has, by all means, smash the like button. It will help us a lot, and let me know if you like it. If you want me to create more videos of this kind, I always read your comments, and there will be more videos on other companies coming out soon. Certainly this week, I'm recording one on JD. Also, as a result of one of your comments, I know some of you are interested in JD, so I will let you know what my thesis is based on the company's financials and fundamentals. Okay, so stay tuned, guys, and thank you so much for all the support so far. Let's grow together.